Hi everyone, in this video we're going to go through most of the calculations you will find regarding payroll. So here we have some information about a company, and then we have employee information with the hours they work, their hourly wage, their marital status, their number of allowances for themselves, a spouse, and maybe a dependent, and then their prior earnings for the year up to this point. In this problem, the first thing we're going to do is we're going to fill out a chart. And then we're going to compute an employee's regular overtime and gross earnings for this time period. And then we will come up with their Social Security and Medicare taxes, as well as their federal income tax. And then finally, at the end, we're going to review the journal entries that the company would make for these 4 employee wages. Do this problem in a bit more detail and look at some of the most important things. So it tells us in the first sentence that this is for Low Country Goods and has 4 employees, and they pay them on an hourly basis. So these are not salary employees. The next thing it tells us is that this is for the week of June 24th to 30th. And then it says these employees work the hours shown below. We're going to then calculate their pay. Any hours beyond 40 in the week is considered overtime, which is pretty standard for hourly wage employees, not so much for salaried employees. And then it tells us that overtime pay is 1.5 times their regularly hourly rate. All right, so we're going to fill this chart in on the next page. And I've already filled in their basic information for us, you'll see in a minute. So we're going to start at number 2 here, where we're computing their regular overtime and gross earnings. So let's go ahead on this side and make some notes for these employees. So first, let's look at their overtime hours that they'll have this time period, and then the overtime rate. All right, so first off, let's write down how many overtime hours each employee worked. So our first employee worked a total of 48 hours, which means there were 8 overtime hours. The next employee worked exactly 40, so that's 0 overtime hours. The next employee again worked 48, so 8 overtime hours for her. And then our last employee worked 50, so that's 10 overtime hours for that employee. Next, we're going to take their hourly rate and we're multiplying it by 1.5 because that's 1.5 times their normal rate for the overtime rate. So our first employee on the list, their normal hourly wage is $11.50. So if you multiply that by 1.5, you would then get $17.25 for each overtime hour worked. All right, for our next employee who makes $11 an hour, that multiplied by 1.5 would be $16.50 for each overtime hour. The next employee down who makes $12.50 an hour, their overtime rate multiplied by 1.5 would be $18.75. And then finally, our final worker who makes $10.50 an hour, her overtime rate would be $15.75. And each of these is just taking the original hourly wage and multiplying it by the 1.5 given. All right, next up we're going to fill in this payroll register with all the details of our employees' payroll information. So let's do these one at a time. And right now we're focusing on this earnings area here. We're looking to fill in their normal pay, their regular time earnings, and then their overtime. And then we will add them together to get their gross pay amount. All right, so remember our first employee, they worked a total of 48 hours, so that's 40 regular hours and 8 overtime. And so if you multiply the regular hours by the typical rate, you would get that this employee's regular earnings for the month would be $460. And we're rounding any calculations we get to the nearest penny if we need to. And then if you look at that employee's overtime rate, we said earlier that that rate of 1.5 times that percentage was 17.25. Let me erase that. And so the overtime hours, 8 times 17.25, would be 138 for the employee. And then when we add those two numbers together, we would get $598 even for their gross paycheck amount. All right, and then for the last column, we are going to go over here to this prior cumulative earnings column, and we're going to add the gross amount to it. So 1 plus 2. We're adding their prior cumulative earnings with the current earnings. And so if we add those numbers together, the $16,975 plus the new earnings of $598, we would get $17,573 as the employees' updated wages for the year. And this is important because Social Security tax, for example, only applies to the first portion of your income and not to maybe any portion after you reach a certain threshold. So this is something that employers need to track. All right, let's repeat this process. Our next employee, Carlos Cortez, only worked 40 hours. So if we take 40 and we multiply it by $11 an hour, we would get regular earnings of $440. We get no overtime, and then the gross amount would be $440. We update his cumulative earnings by adding the prior earnings with the current gross amount, and so that updated amount would now be $16,520. All right, our next employee has 40 regular hours and again 8 overtime hours. So we'll divide these up between the two columns. The regular earnings, if you multiply 40 times 12.5, would be 500. And then the overtime hours, let's see if I can squeeze it in here on the side, was $18.75 for overtime. So if you multiply 8 times $18.75, you would get $150 for Jane's overtime pay. We add these together for her current gross pay would be $650. And then finally update the cumulative earnings to $18,290. All right, I'm gonna fill in the last one just real quick, and hopefully you can verify that your calculations would be the same. All right, I filled in the information for Sarah. You can see she worked 40 hours of regular time and 10 hours of overtime. We've calculated her regular earnings and overtime and updated her gross and cumulative pay. The last thing in this portion of the chart is we would add up all of our employees' current wages here, and it would be $2,265.50. So we will need this information later because this is our wages or salaries expense that we will record in a journal entry. It'll come from right here, the total of all of our employees' gross pay. All right, the next part of our problem is number 3. We're going to calculate Social Security tax. And Social Security tax is something hopefully you've heard of in the past, and it is applied on 6.2% of the first portion of your salary. It's usually a pretty high threshold. Since our book is older, in reality today, this is quite a bit higher. It's adjusted for inflation every year by the IRS. And so that's our pay rate here for Social Security. And both the employee and the employer pay the same rate. In this part, we're calculating the employee's portion of that that's deducted from your paycheck. All right, so let's go ahead and do that, and we'll be multiplying an employee's gross pay, which includes any overtime, and we're multiplying it by 0.062, which is 6.2% as a decimal in a calculator. All right, in our first column right here, we're saying what portion of the gross pay is taxable for Social Security. And this is where we need to verify that our employee hasn't gone over, in our situation, $142,000 cumulative pay for the year. And you can see in this column on the end that none of our employees are over that threshold at all. So their entire gross pay would move into this column because it's all subject to Social Security taxes. So we're just bringing these over from the gross amount right here. Again, because all of their wages are subject to Social Security tax. And then next in this column, we'll be multiplying it in our calculator by 0.062, which you remember is the same as 6.2% as a decimal. All right, so our first calculation, you would take 598 and multiply it by 0.062 in your calculator, and you should get $37.08. Do the same thing for all the remaining employees. All right, so this should be the number that you get when you take all of your employees' taxable wages and you multiply it by 0.062 in your calculator. Last, you're going to add up each of these numbers into a total, and $140.46 will be right here. And this later on will go into a Social Security tax payable account in a journal entry. All right, next up we are calculating Medicare taxes in number 4. And in this situation for Medicare tax, it's 1.45% on all of an employee's wages during the year. And this same percentage is paid by both an employee and by the employer. All right, because there is no cap on our Medicare taxes, we'll just fill in the employee's whole gross salary in this taxable wages for Medicare column. All right, that's again just the employee's gross wages from above. Next, we will be putting into our calculator a decimal of 0.0145, and this represents 1.45% as a decimal. So be sure to enter that correctly into your calculator. And when you multiply the employee's gross wages by that decimal, for the first one, you get 598 times 0.0145. You should get $8.67 for your Medicare taxes. We'll do the same thing for each employee. All right, we've got each employee's Medicare taxes filled in, and then we'll total that column up, and it will be $32.85. And this will go into an account called Medicare Payable. All right, next up we have number 5. And number 5 has to deal with our federal income taxes that are withheld. Now you might have done this for your own job, and an important form that goes along with this is called an employee's W-4. And this is where you set allowances for a spouse and for any dependents. So they do their best to withhold the correct amount from your paycheck for federal income taxes. So you see here, our employees, we also show their number of allowances in this chart. And we also show their marital status because that makes a difference. And they supply us with some federal income tax withholding charts that we'll be using to figure out the correct amount of taxes to withhold for a weekly paycheck. And so for this first one, for Amora, we'll look at the married federal taxes withholding chart in a minute, and we'll see that she has 4 allowances, probably for herself and maybe some kids, or herself, a spouse, and kids. So let's go look at one of these charts together. All right, so here in front of me, I have a married person payroll chart, and you can get something like this from the IRS, and it's updated every year. And our first employee was Amora, and it said that she was married and has 4 withholding allowances that she's claiming. And we also saw earlier that her weekly paycheck was $598. So we'll come to this chart and look for where this person would fall into the category. So with this employee's paycheck being $598, she would fall into this category right here, between $590 to $600. So then we find the number of allowances. She has 4. So we'll come to the column 4 and you'll see that she should have $20 of federal income tax withheld from her paycheck. And we'll just simply take that to the chart we did earlier and fill it in. All right, so right here, $20 in federal income tax is withheld. Now, sometimes this federal income tax withheld is given to you, and other times you need to be comfortable using the charts. So let's do one more together. Let's look for Sarah Wise. So this says she has 2 allowances and she is single. So let's go find hers as another example. All right, so now we're looking for our employee Sarah. It said that she was single and that she had 2 allowances. And we also know that her weekly paycheck this time was $577.50. So again, we'll go to our chart and see what range she falls into. So looks like right about here, that would be her paycheck between $570 and $580. And then we'd move over to where she has 2 allowances, and we would withhold $54 from her paycheck for federal taxes. All right, so we would fill in $54 for Sarah. We will go through the same procedure for the other ones. The other employees are married and have 1 allowance. And so I'll just go ahead and bring those numbers over. So Carlos, you should get 23. And the next employee, Jane, you should get 52 on the charts. All right, we'll add all of the income taxes together and we should get $149. And this goes into our federal income tax payable account. All right, the last thing we would need to calculate is the employee's net pay, which I accidentally left off at the end. But in this amount, we will be taking the employee's gross amount minus all deductions that we've made and withheld. So for example, on Amora, we would take the $598 gross pay, we'd subtract the Social Security, then the Medicare, and then the income tax. And if we did that, her then net pay would be $532.25. And we would do that for every employee. All right, so again, for the net pay, I've taken each employee's gross and subtracted their Medicare, Social Security, and income tax. And then the total for all our employees, their net amount would be $1,943.19. And this last total would go into a wages payable account because that's the cash we would actually owe to our employees. All right, going back to our problem, we have already computed their net pay. And so now we're looking at preparing 2 journal entries, which is the last piece of this problem. The first one is to record all the calculations we did in that payroll chart. Okay, and then the last one is where we actually pay out in cash to our employees. All right, so good news here. We've already done all of our calculations already. We just need to put them into our accounting records. So we have our wages expense right here we calculated. That's their gross pay. We have total Social Security right there. We have total Medicare, which will go into Medicare payable account. We have total income taxes payable, also going into the income tax payable account. And then finally, we have our employees' net pay, which goes into their wages payable. So let's line that all up in a journal entry. All right, the first line we're going to record on June 30th, which is the date we're calculating payroll. The first line will be our wages expense, and this is for the gross amount. And this is recorded as a debit, just like all of our expenses we've been recording all year. And the total there was $2,265.50. All right, and then all of the other items will be credits because they're all going into payable accounts. So the first calculation we did was for Social Security tax payable. And from the chart earlier, that total was $140 $1,000,000.46. Then we had Medicare taxes payable. And that total was $32.85. Then we had income tax payable. And that total was $149. And so you could take the difference there if you'd like to see what the remaining item would be. But you could also get it from the chart. It should go into wages payable for our employee. That's what we actually will pay them out in cash. And that total also from the chart was $1,943.19. All right, and you can always add that up and double check that your journal entry should balance. All right, last up, we have to do a second journal entry later on when we actually pay out the payroll, the payment. Think about payroll's usually delayed a little bit, and a lot of companies will transfer the funds to a bank and then issue the payment out of that bank account. So it's saying this happens on July 3rd. And what we do is we remove the wages payable account from above by doing a debit. And we take all that money out. And it's $1,943.19. And then we're going to show the asset of cash going down. And we do that with a credit. We're paying all that money out to our employees, checking or direct deposit. All right, and we would be done with our payroll. And now wages payable would have a balance now after that second journal entry of 0.